Hello everyone, how's it going? In this video, we're going to talk about DWAC or Digital World Acquisition. So this company, following our coverage about Rumble yesterday, is a good follow-up because it belongs to the same kind of category or niche of the market within the internet stocks or the growth stocks, with some key differences. So the first one is it did gather a lot of interest from shareholders back in 2021. The stock rose to very high levels, almost seemingly impossible to sustain at the time. And this, by the way, was the reason why I didn't buy it, back then, which in the retrospect was a good decision, but I didn't have any other indication that it's not a good idea. You see what I mean? People were optimistic, people were enthusiastic, and with time, this interest eroded away. Maybe it's because of the erosion of time, or it's because of the reality check, simply. Before we go on, I must say that there is a key vote that is ongoing, so make sure to vote if you are a DWAC shareholder. So this vote, what it does is that it allows the SPAC to extend its useful life, right? Because a SPAC, what happens is that it first goes public. It's a blank check company, so it's not supposed to fluctuate a lot unless there are a lot of exciting news coming in, this and that. So they usually have a floor price of $10 or $20, which is indicated in the contracts from the get-go. And then from there, what happens is if the SPAC doesn't get a merger target, so a company to merge with, they will be liquidated within 12, 24, 36 months. So that is the idea. And upon liquidation, whatever they've said at first, like how much a share is worth, is going to be reimbursed to the shareholders. So that is the big plan. So I would recommend those who have a share or an interest in DWAC to vote if you can. Yes, no, maybe, it doesn't really matter, but what matters is you express your opinion, which also, comes to think of it, is kind of in line with what DWAC and Rumble that we covered before are supposed to be, right? It's a place to express your opinion, so why don't we express our opinion during this vote? Now, this company is also very emotionally charged, which can be a double-edged sword, because the good part is it's very good for momentum. You can have a lot of people piling in at critical moments, which can change the final outcome. So the bad part is, just like it attracts a certain kind of retail investors, it can also drive away some other kinds. So, I mean, you give and you take, right? This is the rule of the game. And also, not only from the retail investors, but also the institutionals, as well as future commercial partners. So this is something that we have to look at more down the road. For the time being, I think that the good part plays more than the bad one. Oh, of course, there might also be something from the regulators, saying we're not super hot about this idea, so why don't we just slow down the pace and drag things on as much as possible? So this is a bit of a theory, but for now it doesn't have that much backing in the real life yet. The business model is very simple. It aims to merger with social media or alternative social media websites. And on paper, this whole thing, this idea may look thin, okay? Because there have been experiments of, other than our behemoth of social medias, like YouTube, Twitter, whatever, like Tumblr, Pinterest, if you want to come out with alternative websites like VidMe, Rabbit, if you guys remember, or Vine. Actually, Vine is like an extension of Twitter, but even then, it didn't really survive. A whole bunch of news websites, they didn't really stand the test of time, right? So the idea is always exciting. Putting together PowerPoint slides is always interesting, and presenting it in front of VC is as well. But when push comes to shove, when they need to make money in order to survive, this is when a lot of those companies would not be able to stand against the test of the time. But this time, though, so I said that on paper, it looks a little bit thin, right? Because all the previous experiments, they rarely survived. This time, it might be different. Because I think that with what DWAC proposes, there might be a real demand for it. Albeit like maybe a niche demand, but it's a real existence. And I think that it's been proven by the whole, partially proven, or maybe indirectly proven, by the whole Elon Musk and Twitter episode. So, social media users have been looking for some significant change, which I think are going to come with difficulties from within, because they all have vested interest. They have billions of dollars in stake. They have, a lot of institutional shareholders who don't want to see things being different from what they're used of. So this is why I think that the users on those social media platforms have been ready to make the switch for some time, as long as there is this kind of opportunity. Now, I haven't really talked about it yet, but the reason why it remains a little bit thin on paper still would remain in reality if those websites cannot find a way to sustain themselves financially in the long run. Because obviously they cannot just run on Patreon. You see what I mean? Like they have to incur their hosting expenses. They have to figure out who is willing to put ads on their websites, sponsorships, and so on. Now, this might open doors to new opportunities, but it may also expose them to more, to less savory commercial partners as well. So it's a bit of a double edge, and it depends on how they want to play it out. There could be a lot of money to be made, but I think that even then, money is not, first of all, it's probably not going to be the main goal of those media ventures. Okay, it's more going to be for influence. But even if we look at the whole thing from a stock perspective, so the assumption is you're going to buy DWAC with the expectation that something good is going to pan out at the end. Okay, so if we follow this train of thought, then I think that DWAC is going to jump sometime in the future, because there is an expectation that it's going to merge with something promising that goes in this way. Is it going to make money? Well, I'll tell you what, social media didn't make money for years. Tesla didn't make money for years. Reddit, one of the most popular websites on the internet, didn't make money for years. I'm not even sure that Reddit is in profit at the moment. Okay? So, all these piled in, I think that profitability is not going to be on the mind of stakeholders and shareholders for some time. They're willing to let it go for a few years before people say, okay, now, you know what? It at least needs to be, broken even. Anyway, this issue is not a big one, but it's something to keep in mind if you want to, buy it for the long term. Something to keep in mind, though, is that as far as DWAC is concerned, we got to be careful of what I like to call the CCIV scenario. Meaning, there are people buying the shares, so we are the public shareholders, right? There are also preferred investors or private investors, those who have been putting their money in the WAC before the whole deal when became available to the general public. So I think it's called like a pipe deal, a like a public private something mechanism allowing some people to take a bigger share of the cake. So that is something that might be under serious negotiations or intense negotiations. And at the end, they may collectively decide, well, you know what? If we have to sacrifice one party's interest, then the interest of the public shareholders is a go, right? Because this happened with CCIV, which became Lucid afterwards. And this is what prompted, or caused, rather, this is what caused Lucid's share price to collapse from $50 or $60 down to like 13 at the time. I know because I was there. Now, because they've pulled this stunt out once, it doesn't mean that they're going to do it all the time. So, that doesn't mean that the same trick is going to be pulled on DWAC. Maybe, maybe not. But it's definitely one of the scenarios that you have to keep in mind buying the stock in. So it's possible that there will be significant retracements once the deal goes through. It's a bit counterintuitive, but other than selling the news, there's also some of those deals that may cause some serious tumbles with the share price. So one final thing. For whom is the stock for? Generally, I would say that, it's for people who believe in the company. But in this case, I want to say that it's also for people who believe in the cause. If you want to have alternative platforms where you can meet people and share your views, then this might be something for you as well. Okay. Having said that, you should also be able to stay for the medium to long haul, because companies like those, they don't take just a few months to develop. Now, obviously, if you're only here for the short run profit, then I would say that as soon as a merger deal is rumored to go through, that might be an exit strategy. Okay, that's for the short term play. Long term, I would say, go in now, but also go in later to possibly down your average cost. And it's also for investors who are not afraid of significant price fluctuations. So predict for something like 30 to 50% of, stock price change, just in case. It doesn't mean that it's going to happen for sure, but you can't be too careful with this kind of ventures. So my recommendation would be to buy, but make sure that you correspond to the profile that I've mentioned earlier, and limit your exposure to what you can afford to lose, whatever that amount might be. It could be 1%, it could be 3%, it could be 5%, so whatever the amount. And also, depending on your strategy, whether it's short term or long term, then, adjust your trading mentality and approach accordingly. Maybe you want to liquidate your position once there's a possibility of merger coming through, because by then the stock price would jump. Or if you want to stay in for the long term, then buy a little bit now, but also assume that something is going to happen to the stock later on, which will cause a retracement of 30 to 50%, and then dollar average your cost. So this is overall my recommendation for DWAC. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings. which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.